I'm from Indiana, and like a lot of people from Indiana, I love basketball. Growing up, I don't really remember too many homes in my neighborhood that didn't have a basketball goal in their driveway. And when we watch basketball, we know there's many different approaches to building a team. There's also many different situations throughout the game where we want to use a different lineup. And so I want to use basketball to talk about the concept of adaptive portfolio management and what it is and how it differs from the traditional approach to investing. So traditional investment management has always been something along the lines of, hey, you're a moderately conservative investor, so we're going to give you 60% stocks and 40% bonds, or we're going to give you 70% stocks and 30% bonds, etc. Well, that's really kind of similar to taking a basketball lineup and saying, okay, we're going to put 3 guards on the floor with 2 post players. Well, we know throughout the course of the game that the players we have on the floor, they're going to get tired. We also know that we're going to run into many different matchups and many different types of teams, and maybe one of these teams, they like to do a run and gun offense. Well, we know in that situation, the 2 post players we have, they might not be set up to succeed in that type of environment. You see, having a fixed lineup and not making substitutions or not making in-game adaptations really doesn't work for basketball. And it certainly doesn't work for investing in portfolio management. We know as markets move along, the securities in our portfolio can kind of fall out of favor. We also know that there's many different markets environments, and what works well in one market may not work really well in a different volatile environment. Managing markets is about building the efficient portfolio. The one with the highest return for the least amount of risk. It's about putting the right lineup on the floor that's set up to succeed given the environment. And that efficient portfolio, because markets are dynamic, it's a moving target. The portfolio that works well in a bull market is certainly not the same portfolio that's the most efficient in a bear market. Just like you wouldn't, the lineups you have at the beginning of the game set to score the most amount of points may not be the same lineup you have at the end of the game when you need to play lockdown defense in the final minute. I'll end with another analogy. Markets are like weather. They're dynamic and they're ever-changing. Your home utilizes an adaptive process. It's called the home thermostat. If it's cold outside, the home thermostat pumps in warm air to keep your indoor environment comfortable. If it's too hot, it pumps in cold air to keep your indoor environment comfortable. It's an adaptive process. Effective and efficient portfolio management also requires an adaptive process like the home thermostat.